All right, welcome to this week's podcast. A quote that I've been thinking about this week is from Bill Ekstrom, and he says, "What makes you comfortable can ruin you. What makes you uncomfortable is the primary way you can grow." And as an entrepreneur and working in my field, I've just learned that's been true in my life. And having a hunger to grow and improve has been really important. So I challenge you guys, obviously be content and thankful for where you're at in life, but also in business, it's important to be flexible and willing to grow. And so, but this week I have a special guest, Gary Presnall. He's a local lending expert, and he works at Northwest Bank. And so, love to pick his brain. He's a really good businessman. He really cares for his clients, and he's an expert all things mortgage. So, thank you for joining us this week, Gary.
Yeah,
so,
thanks, Jason.
Yeah.
Yep.
So, all right, awesome. Let's dive in. Let's talk about personal. So, tell us about who Gary Presnall is. And,
okay.
Yeah.
Well, what defines me is I'm a disciple of Christ.
Mm-hmm.
I came to know the Lord 20 years ago, 12 and a half years ago.
Yeah.
And that really defines my life, how I live my life at home, how I live my life at work. So that really defines me.
Mm-hmm.
Married, got 3 kids, 2 grandkids. And just really love serving at my church. That's probably the thing that I love the most is going out and sharing the gospel with people that come to our church and in the community.
Yeah, that's wonderful. So what are the ages of your grandkids?
6 and 2, and then
man.
actually my daughter's got 1 on the way.
Oh, that's so exciting.
Yeah, thank you.
Yeah, it's great stuff. So now let's dive into, we're in Ankeny today. So have you a long-time Ankeny resident then? Or
Yeah, actually live in Polk City.
Oh, okay, that's
lived
right.
there
Okay.
for about 12 years. And,
My fault.
worked in Ankeny
Yeah.
for over 20 years.
Got
so
it.
That's my makeup. Yeah.
Got it. Okay, well, tell us about professionally, where are you at? What's been your professional career in the mortgage industry?
Yep. So I've been financing homes for about 20 years, a little over 20 years, and I really just enjoy getting people into homes and obviously affordable homes.
Yeah.
Always want to do what's best for the borrower, just not to get them into the house, but what's going to work best, loan program, and really what's going to work best for them and their family, and not make them really tied to the house, that they're comfortable and they can still go out to eat and put gas in their car, and so you always want to look out I always want to look out what's best for the client.
I think it's really important in real estate industry, whether it's a home inspector, real estate agent, loan officer, that they have more of a consultant, heart of a teacher attitude versus this primary salespeople, because they are only focused on sales. They're not really focused on the individual. And so I know my clients really appreciated that about you, because it's so, in Latin, mortgage means debt till death. And so it's really important that there are people like you that are in the mortgage industry that will say, hey, what's your whole life goal, type of thing, like what you're saying, that they can afford, so they can afford to eat.
Yeah, absolutely.
So,
it's uneven with people with bad, not so good credit. We just don't want to send them out the door. We want to try to give them a plan of how they can maybe rebuild their credit and get them to the point where they can actually get into a home.
Yeah, no, it's really exciting. Yeah, even just historically speaking, one of the primary things that can really help people build their wealth is owning a home. And there's been consistent articles there where a lot of people say if you can own a house, not short term, you can make money in a sense, but in a sense for 20, 30 years, it's a good way to, if you can end the rent cycle affordably and wisely, it can be a really good option to own a house. So,
totally agree.
So you've been doing this for over 20 years.
Yeah.
So how has the industry changed for the better, would you say?
I went through the cycle of when the mortgage market crashed.
Yeah.
And then prior to that, it was there was loan programs for everybody. I mean, the term was, if you could breathe, a borrower could breathe on a glass, breathe on glass and show that they're alive. Basically, they could get into a home. And that's not really what the mortgage industry is all about. It's not everybody should own a home. it's great if we can get as many people into homes as possible,
Absolutely.
but it's not everybody that should own a home. So it's changed drastically from no income, no asset verification for people. Now it's more since we went through that bad cycle of lots of foreclosures and bankruptcies, and that's all because the government allowed, laxed the standards for people getting into homes, and so now that's swung the other way, and it's a little more stringent, which it should be. It's just swung the other way where now you've got to verify income and assets, and the borrower's got a certain debt ratio that they have to stay within, and so the guidelines that are put in place is really to help. It's got to be to protect the borrower.
Absolutely, yeah, for sure. I mean, during the recession, it seemed like there's a correction. That's what a recession happens.
Yeah.
And the federal guidelines for mortgages were just way too lax and putting a lot of pressure on, it seemed like, on banks at times to just pump out loans if they could breathe, just get it. And that just wasn't, the wisest thing. But a recession is a correction, and things seem like they've been really a lot better.
Yeah,
and
markets swung back, and people are, market's still vibrant, and the rates are still low. So that's really positive. And it appears that the rates are going to stay low just under the current administration. I think the goal is to keep rates low and housing continue. That's one of our biggest industries is housing in this country. So it's important to keep that going.
Yeah, absolutely. Yep. When you started, this might be too off the cuff, but what's been the highest 30-year mortgage interest rate that was like the standard in the last few years?
With me doing mortgages, I think the highest it got maybe was 5.25%.
Oh, okay, got it.
And over the last 60, 70 years, the average interest rate for a 30 years is about 7%. So we've seen rates as low as 3.25%.
Yeah.
And then, of course, we've seen them during the Great Recession in the early 80s, the farm crisis. We saw rates, closer to 20%.
Yeah.
So where rates sit now, currently at 3.5%, boy, that's really
historically
really
speaking,
good.
Historically speaking, it's unbelievable. Yeah. And this year, it's been a good year for rates. Last year at this time, it kind of went up closer to that, almost to 5%, but then it went back down and got as low as about 3.25%, 3% on a 30-year mortgage. So,
there's a segment of people that bought in the last couple of years that were over that 4.5%, 4.75% mark that now are coming back and realizing that the rates are a lot lower and actually refinancing.
I was with a client this week, and they bought a house only about 18 months ago, I think it was, and their rate is at I believe 4.75%, and we ran a scenario. They're going to verify on this, but basically they might be able to save about $175 a month if they can refinance, and so that's why refinancing might be worth considering if there's anybody out there that probably has 4.5% or higher interest rate, probably.
Maybe even 4.25%.
Yeah,
depending on their balance. I mean, just a drop in the rate is one thing, but what to consider is your loan balance, and because a drop in the rate, if you owned $100,000 and the rate dropped to 0.5%, that's probably not enough to refinance. So.
Absolutely. Well, cool. So I work with a lot of first-time home buyers. Over the last almost 10 years working in this industry, I've worked probably with over 200 first-time home buyers. Can you explain to the audience what is the process of getting pre-approved, just from basic terms? What does that look like?
Generally speaking, I prefer borrowers just call me, and then I can take their information over the phone. The process is quick. It takes me about 5 to 10 minutes to just get it entered into my system, run credit, and you can have a pre-approval within a half hour to an hour's time. We also have our website where people can apply for a loan. I also have a really cool mobile app that people can get pre-approved and just use their their iPhone or whatever device they have to get pre-approved. So it's really pretty easy. It shouldn't be intimidating to anybody.
Yeah, absolutely. I recently, my wife and I are looking into an investment property, and we went through that application through your website. It's really, really easy. And so it was real simple. And so the main thing, what do banks look for? So if someone's considering wanting to buy a house, what are some of the big things that banks are looking for qualification purposes?
Yeah, so one, of course, the big thing is credit score. There's a minimum credit score, and generally speaking, it's 600 and above. And then the other thing that we'll look for is your debt to income ratio. Depending on the loan program, conventional loans, you can go up as high as 50% debt to income ratio. And then some of the government loans that you can go actually higher than that. So that's generally the things that you're looking for is debt to income ratio and credit score, and 2-year history of work history.
Yeah, absolutely. And so debt to income ratio from a most basic terminology, so it's just they focus on, if you're in your job for at least 2 years, they're looking at your gross income you bring in compared to your gross debt, and you focus on, is it per month? Is that what you focus on in general?
So it's gonna pick up off a credit report. It's based on whatever's on the credit report. So it could be it's credit card minimum payments, student loan minimum payments, car loan minimum payments, and so you take that and divide that into your debt, your gross income.
Per month. Yeah, so gross debt compared to your gross income, and it can be, and generally speaking, you said what can that be? So if you make $5,000 a year, this is all very high level, all generic. Every applicant is unique, but if you make $5,000 per month, then you're saying up to about 50% be the absolute max.
Right.
It can be the debt load that you carry.
Right.
So.
So that's not going to take into effect, gas in your car, and utilities, and food. That's just based off the gross.
Yeah.
So it's in everything that's going to appear on a credit report.
Yep. It's important to have, when you work with a loan officer, it's important to have someone just take another step and talk about your budget too. And so just because you're pre-qualified for that amount of money may not be the best thing.
Exactly.
Or at least have someone advise and consult you like what Gary does.
Right.
Things like that. So.
Exactly. Yep.
If someone applies to get pre-approved, but let's say their credit score is at 550. When I graduated from college, I had a lot of student loans, and there was one loan that I opened up I didn't even realize I did because I had so many student loans. I didn't pay for it for 14 months, basically. I didn't know about it. So I had bad credit. My credit was actually okay overall, but thankfully I caught it and then it raised. But what are some ways that you try to help people? So if they apply for a mortgage with your bank and they don't have high enough credit score, how can people build it? What do you do to help them?
So we have a tool called Credit Expert, and so what I can do is put into this module, if I need to raise their credit score, say 50 basis points, I'll put that in and it'll tell me exactly what to do. So if you had a credit card maybe that showed a $5,000 balance, it will tell you, okay, pay your credit card balance down to $2,500 and your credit score will go up 50 basis points. So that's really what you're looking for. Is, you're trying to give the borrowers a tool that they can shoot for and give them a plan that will take them to the point where, it could be judgments or collections that need to be paid. So it really, it may depend, but generally speaking, we always seem to see borrowers that have credit card balances that are close to the maximum credit limit. And if they pay that down, and generally what they're looking for is at 30% of their available credit limit to pay that down to. That's generally what they're looking for.
Yeah, absolutely. So if you have a credit card and let's say you are at $1,000 max, you're at $950, if you can just reduce it down to that, get it down to about $300 roughly, then that's generally what banks like to see then on your credit card max.
So because if you see someone with a max credit card, that generally is a red flag, and so the credit bureaus will penalize the borrower for that until that balance gets to a certain limit to where it's it's not near as risky.
Yeah. One of the little things my wife and I do, we don't like debt. We graduated from college. We had a bunch of college debt. We've thankfully been able to attack it. But at this point, our viewpoint on debt is we have a credit card, and we just want to keep our credit. We just buy it for things that are just automatic, like gas. But then what's really nice with the bank that we bank at, it automatically pays off each month. So I think the big thing with credit is you're applying for hundreds of thousands of dollars, and so the bank needs to do their due diligence. And if for some reason, also as borrowers, if your credit score is not where you want it to be, where the bank can give you a loan, what's really important where Gary can help out with is set a plan. If you want to buy a house in the next 6 months or a year, he can do a module. And I think it's important to realize just because it's no today doesn't mean it's going to be no.
Right.
Yeah. So for a long time.
Yeah, I think that's important. It's easy to tell somebody no, but it's much harder to give somebody a plan and give them a viable plan that they can work toward because, just like you said, it may be no today, but you want to give someone a plan to how they can get to a position where they can actually buy a house.
And kind of a cool story was we actually have a borrower that's working, our team is working with Gary on a deal, but she posted on Facebook yesterday, and single mom, graduated from college a few years ago, and she just worked so hard to get to this point. And such a neat thing to see. Her credit's always been good, but just seeing how just saving money and working hard and she's just so excited for the house that she's buying. And so it's such a cool thing to have a plan. It's so empowering. And I know with my clients, sometimes it's a savings plan. Sometimes it's credit plan. I'll send you to Gary or someone's an expert that way to build your credit. But it's such an exciting thing to kind of control that and have a plan. It's very empowering to have. So.
Yeah, it's really a privilege to own a house. And the cool thing is, we all do what we do because we make money at it. But I get great joy out of a family that can get into the house that they really wanted, and that's what's important.
Yeah, absolutely. Yeah. Absolutely. So what loan mortgage programs does Northwest Bank offer?
We offer a lot of the standard VA loans, which is 100% financing, rural development, which is USDA, which is 100% financing, your normal conventional loans, FHA. We also offer some portfolio loans, which is a product that we wouldn't sell to Fannie Mae or Freddie Mac or Ginnie Mae. We would actually keep that loan at the bank. So what those are going to encompass is we have several 100% financing products.
Okay.
We have a really great doctors program that's not only for doctors, but it includes your nurse practitioners, your PAs, anybody in the medical field, actually dentists, chiropractors, mental health. We try not to limit it too much, but those are the folks that have decent credit, 700 credit or better, and not a whole lot of debt, but maybe not a down payment.
Yeah.
And so we have those. They may have gone out and paid off all of their debt, and now they're maybe debt-free or very little debt, and just don't have the ability to put any money down.
Yeah.
We have a product that allows them to just put no money down, and we would keep that loan at the bank.
That's great. And then, so VA loan, that loan is for veterans, right? People that have served.
Correct. Yep. Or been in the military. I think 6 years is the service level. They can be a veteran, or they can be in the reserves. So that do a fair amount of those. And of course, more and more vets that we get back that. That product is it's widely used. Yeah, absolutely. No, that's great. What's usually kind of the minimum down payment of the different products that we talked about? So FHA would be a 3.5% down. VA, you can go up to 100% financing. The USDA or rural development is also 100% financing. I mentioned the portfolio loans that we have; those are no down payment. But when you get into conventional loans, the minimum down payment, if you're a first-time home buyer, which means that you haven't owned a home in the last 3 years, you can put as little as 3% down. And then there's also options on those conventional loans where You may not have the 20% down to avoid the private mortgage insurance. We have ways to eliminate that P.M.I. insurance or private mortgage insurance, so the house is more affordable for the borrower.
That's great. So, you kind of alluded to this a little bit, but can you take a quick elementary level education on what P.M.I. stands for our audience?
Yep. So way before I started lending money, you always had to have 20% down. Well, as the market and the mortgage industry changed, they came up with what's called private mortgage insurance companies. And so anytime that you don't have 20% down payment, now these private mortgage insurance companies will insure the difference between 20% down and maybe 5% down. So they're going to insure that other 15% in case the borrower defaults. So P.M.I. insurance companies are that. They exist to provide that private mortgage insurance so borrowers can put maybe just the smallest down payment down and still be able to get into a house and not have to save until they get 20%.
So generally your mortgage payment is principal of what you owe on your on your house, then interest, taxes, insurance, and then if you don't have 20% down, generally speaking, borrowers need to understand there can't be a P.M.I. prime mortgage insurance depending on the product they end up getting.
Right.
And then when is it generally speaking when you get to that 20% of equity that would drop off, or 78%? I've heard it both ways. Yeah.
So if you didn't do anything with the P.M.I. insurance to try to get rid of it, you would pay that on a monthly basis. And then it would automatically fall off when they're at 78% loan to appraised value.
Got it.
It could fall off sooner than that if the borrower puts additional funds down as they go, or the house appreciates, or both. So it can come off sooner than that.
That's great. That's great. So for recent grads, so I work with, I'm around a lot of recent grads, or not a ton, but often enough. But what people are entering just in general, you've been working professionally in the business field for over 20 years. So what advice do you have in general if I was a recent grad?
Yeah.
Maybe I was going to work at Principal or Nationwide, one of the big. What general advice would you give?
Yeah, I always think owning a house is far better than renting. So I think I'm not so sure owning a house right when you get into your first job in the first month or two, you want to try to build some reserves in the bank, and but I would say if you know your credit is good enough, and it's you feel that you're job-wise you're going to be stable enough, and you think you're going to stay in this area, then I think certainly looking into buying a house is the way to go. It's a great way to build credit. It's not why you buy a house, but it is a good way to help your credit and to build equity and instead of throwing money away on rent. Yeah. So I would say just developing a relationship with the banker like myself, and maybe check your credit and see where you're at, and see if there's things that you need to get rid of or improve your credit before you actually buy a house. Yeah. So that would be where I would start.
And there can be some creativity too with young professionals that maybe have some college roommates that are working professionally as well. Where I have one client right now, he bought a house and he has 4 roommates, and he's going to get about $1,600 of rent.
Right.
And then he hopes to be married down the road, but $1,600 for a couple of years, that adds up. You know?
Yeah.
And but he can afford the payment by himself. But so there's ways to, in a sense, where you can get creative. So I think working with a loan officer that knows what's going on, and then a real estate agent as well. And you're right on. Like if this is an area you want to be in for at least 5 years, the Des Moines area, maybe might as well just consider it.
Yeah.
And thankfully, since the recession, I mean, homes have been appreciating for the most part every year, depending on the price point. But they've been appreciating each year. And what that means, simplistically, if you bought a house 5 years ago, kept up with it, it should be worth more than what you bought it for, and that can be a really nice thing. And then, so that's something to consider too. So
and even living in this in this area that we live in. It's an affluent area, and we're not recession resistant, but we just don't have the highs and lows that you may have on the east or the west coast, and it's fairly stable, and the odds of you getting hurt owning a home is at least here in the Midwest is pretty low.
Yeah, consistently Des Moines voted top 10, like for anything you can think of, like top 10 to raise a family, top 10 for a job, top 10 for work-life balance, all that. So Des Moines, we're very privileged to live in Des Moines, and this is all I've ever known, but I have clients moving from out of state, and they just think this is a wonderful place.
Yeah, it is. It really is.
So now, I always ask my guests some more general questions, and so maybe away from the industry that you're in specifically, but when someone in general faces adversity, like how do you handle adversity? What are circling back to the quote at the beginning of the podcast, it's like what makes you comfortable can ruin you. What makes you uncomfortable can be the primary vehicle for you to grow. So what are some adversity? Yeah.
I read that question that you had for me, and I was trying to think through that.
Yeah.
I really think adversity makes us better. Stepping back, God's in control.
Yeah.
God's in control. Nothing surprises him. And I look at it from the perspective of why are you doing this? God, maybe God's brought this into my life for adversity to grow me. I step back and say, not why are you doing this, but what are you trying to teach me?
Yeah.
And so I think adversity can really make us better. And certainly our trust and hope is trusting in God's plan and knowing that He's got it worked out for good. So I would say with adversity, either at home or business, I try to look at it from God's perspective and what He's trying to teach me.
Yeah, absolutely. Yeah. No, absolutely. I think that it's important, like with adversity, to, in the here and now, if I'm focused on a certain situation in my own life, it can get frustrating. But if I look at it from an eternal perspective, from like you're talking about from God's angle, I think it's important to trust Him, because it's and it's funny. Being Americans, we can complain about the most ridiculous things.
We got it made.
Yeah.
I mean, we're born in this country. I mean, as a lottery ticket, being born in this country.
Yeah.
We've got nothing to complain about.
And I think it's important too. It's just with the Thanksgiving season too, just to point to all the gifts we have and be thankful for. Not make them up, because we have a lot to be thankful for, and
Amen.
God's gifts and things like that. So, so pragmatically, so how do people contact you if they're looking to get a mortgage? What's the process look like with you?
The easiest thing is just to call my cell phone, and that's I can give that to you. It's 515-975-6767. That would be the place to start, and then we can kind of visit about what you're looking for and how soon you're trying to do it, and just trying to get some details of your plan and kind of go from there. That'd be the easiest way to get started.
I think it's important as a real estate agent. I really recommend, before we look at any houses, to get pre-approved.
Right.
The reason why is there's all kinds of online calculators that can be just way off, and if we end up falling in love with a house, it ends up being $200 extra a month than what you thought it would be. It's like, let's not look at those houses until you pre-approved, because it's the best service, to a borrower to have that all planned out. So
you don't want to waste, the borrower doesn't want to waste their own time, and certainly they want to be cognizant of the realtor's time as well. So
well, awesome. Well, thank you so much for joining us this week, Gary.
Thank you.